welcome to the show. How's it going, guys?
Good to be here. Thanks for having us.
Doing well. Good to be here.
Doing well,
Nice.
thank you.
Before we get started, just a quick note that our Crypto IQ test is now live. Go to theblock.co/crypto IQ to take the test, showcase your smarts, and compete for 20K. On a separate note, if you're tracking the crypto treasury trade, we have some fantastic charts on our data dashboard. Make sure to check them out. Now, on to today's episode about on-chain money markets, real-world assets, and evolving yield structures and strategies in DeFi. So, for context, before we jump in, current stablecoin values about 278 billion. That is up about 6% from 30 days ago, and that's across about 191 on-chain holders. Total RWAs are booming. They're at about 28 billion, up about 5% in the past 30 days. And there's an ongoing bidding war for the USDH proposal. That's drama fueled and nothing less than exciting. So for that context, I mean, it's a really timely conversation. TK, starting with you, I guess, before we get there, how did you get into DeFi and RWAs specifically?
Yeah, it's a good question. So I joined crypto in like 2022. Before that, I was a quantitative trader, worked at a couple of different firms in Chicago. I initially got into crypto just through trading it. It was like one of the assets that wasn't restricted for traders working at market makers to trade. So did that for a while. Pretty much the entire desk that I worked at was trading crypto pretty heavily. And then I got into DeFi really heavily in like 2022, 2023, contributed to a few different DeFi protocols, both as like kind of like a developer and also designing some of the mechanisms as well. And then I was really interested in the RWA space when it first started kind of coming to fruition in around 2023. And I thought it was really one of the things that made the most sense for crypto because it's such a natural way to bring on a lot more capital on chain and to make things happen on chain, which thing like stuff that can't really happen on TradFi, the whole composability aspect, the whole permissionless nature of it. And so we started Theo in 2024. We've been building it for about one and a half years at this point. And yeah, that's pretty much it.
Awesome. Thank you. And Charlie, if you could tell folks a little bit about your background, give us some insights there, and also just why you're interested in Hyperliquid so early. I was digging through the blog and saw some interesting articles you wrote.
For sure. Happy to dive in. So I guess, yeah, during university, I started contributing to a couple of different DeFi protocols, particularly on the lending side. That eventually led to starting a risk firm called Antheus Labs, where we worked with a variety of large lending markets on all things risk parameterization. I got into Hyperliquid pretty early via a good friend, Max Figure, Max.hl. But yeah, Max kind of, he and I were catching up around June of last year. He was filling me in on this angel syndicate he was starting called Hyperactive and a lot of stuff he was doing in the Hyperliquid space. And at the time, I had just been sort of a periphery follower. But he kind of came with the idea of, hey, what if your team came and built out, very secure money market infra on Hyperliquid? And that kind of kicked off the idea for Felix, which we started working on fully back in July of last year.
Understood. And I guess kind of going back into the blog piece, you have an interesting article on ecosystem versus product-led development and the next generation of L1s and L2s. So one, what's the thesis for those who are unfamiliar, and what's changed since January when you put the article out?
Yeah, I mean, it's funny you mentioned I keep it pinned just to kind of keep a reference, and I check it myself every once in a while to kind of check in. But the overall thesis is that I saw at the time of writing that there was sort of this dichotomy in L1 development. You had certain teams taking an ecosystem first approach, basically trying to build sort of a house of all these different apps, and then you had other teams, mainly Hyperliquid, taking sort of an app or product first approach and building basically an ecosystem around that product, not as much focused on the ecosystem directly. My overall bet, obviously, that's kind of why I've taken this Hyperliquid path, was I think that that's probably the right approach. I think since that article was posted, Chain went live, Monet and Mega are TBD, so I can't really comment on that side. But and then obviously, HyperEVM went live since then too. So been kind of seeing HyperEVM scale out versus Chain, I guess, is the closest comparison so far. I think it'll be interesting to see how that plays out once Monad and Mega are live too. But obviously my bet is on the Hyperliquid side there. But yeah, it's been interesting kind of see, I guess, the Bear Hyperliquid dichotomy play out.
I guess one of the things I was curious about is how did you lead to, or I guess do you have a preference as to which way people are building out? Like, do you think there's a flawed approach to ecosystem, for example, or too product driven?
I think on the ecosystem side, the issue you run into is you just become, one of N chains with all the same apps, and you're just focused on building the exact same apps over and over, and you're forced to just focus purely on these kind of vanity metrics that don't really drive that much value. Whereas if you're fully building out a product-specific approach, you can just build a great product and then let people build around that product, which I think is a much better business decision. Granted, it's not easy, and hence why in the article you have one example of a product first chain and three examples of ecosystem first chains. But yeah, that's kind of the overall thesis is if you can do it, go product first. But it's not easy.
Understood. Yeah, and segueing a bit, I guess now going to really, I guess the application layer. TK, Theo recently announced that the TH bill is live and it's number one on Morpho, so congratulations on that. Curious, like, which asset classes and protocols currently are driving like supply growth in on-chain money markets?
I would say it's definitely things that have yield to them. So obviously one of the biggest drivers of that in the past year has been Athena. It's kind of just like a yield machine, right? They have their Athena points, their Sats, in addition to the actual carry trade yield as well. And so that's been driving a ton of demand, both on the borrow and the supply side to things like Aave. And then you have sort of downstream players that are smaller than Athena, but still giving good yield on things like Morpho, Oilers, another money market that has had really, really great growth over the past couple of years. So definitely the asset class primarily driving this are things that are yield bearing in nature, more stable in nature as well.
Understood. Thank you for that. And I'm curious, like TVL, how is TVL and DeFi evolved in 2025? Have you seen different patterns versus 2020 where people are gravitating towards? Open, I guess, both TK and Charlie.
Yeah, that's an interesting question. I think nowadays people care a lot more about the actual like utilization rather than just having idle TVL. Like I remember back in the day, a lot of projects would just publish like really huge TVL numbers, but if you kind of looked under the hood, it wasn't really being utilized in a way that was very meaningful. But these days, especially with things like lending markets, what matters a lot more is the actual utilization, like how many people are actually borrowing against their collateral, how much of the supply is being borrowed, things of that nature, which is, that's a great, I think, evolution of the DeFi landscape to get into things like utilization, volume, rather than just looking at AUM or TVL.
Yeah, I tend to agree with TK there. I also think this is something where the Morpho model has helped pioneer that shift. Whereas, there's obviously benefits of the pure pooled lending model, like an Aave or a compound, but a lot of this ends up just parking dead assets that maybe they earn, 50 bips, but they're not actually doing anything really generative for the protocol, if that. And so with the Morpho model, you're basically forced to use collateral assets and you have a borrow lend asset. Those borrow lend assets are what people are borrowing and lending and utilizing. But it doesn't make much sense to just park idle collateral that isn't doing anything. So I think that's certainly helped with this shift and also helped with, Morpho kind of pioneering some of the PT looping, the early PT looping side, a lot of those trades where it was very much an active trade and less of just let me park dead capital here. So I think that's been yeah pretty cool to see.
Understood. And how do multi-chain liquidity flows influence the landscape of these markets? It seems like fragmented liquidity was like a big issue. A lot of DeFi, I guess, believers are calling out early on. Has anything changed there?
Go
Charlie,
ahead,
you want to
TK.
go first?
Yeah, sure, I'll take it. I guess I, thinking primarily from the hyperliquid perspective here, it's certainly an issue that we sought to address early in the, early days of the Hyper EVM ecosystem in particular. I think it was solved pretty quickly via Layer Zero's Hyperliquid bridge, which allowed for a lot of bridging over easily of different stables and different assets to Hyperliquid, or Hyper EVM in specific. But yeah, I mean, I think it's still an unideal UX that teams are constantly looking to solve, and then you have all these kind of bridge providers coming in now who are trying to fill that gap. I think the UX is still a bit, leaves a bit to be desired. But overall, I felt it getting better over the past, I don't know, 24 months. But I don't know if TK, you disagree there.
No, I totally agree. I think the bridging standards have become so much better. You have things like Circle CCTP, which is super seamless to use. You have all these bridge aggregators, which make it really easy for the end user to find the best routes. I remember earlier on in like 2022, 2023, like these things weren't super common just yet. And it was just kind of a nightmare to figure out how to bridge from one ecosystem to another. So really glad that that's being solved. And another thing that I think is really interesting, which it should be coming soon, but there's the new versions of both Morpho and Aave have some types of like cross-chain components to them. And I think that is like a really, really interesting dynamic to have that sort of cross-chain liquidity component embedded within the actual protocols. It should make lending a lot more capital efficient. It should make it a lot more seamless to the end user. Like if I have a balance on one chain, being able to borrow against that on another chain is a really, really cool unlock, in my opinion.
Are there any risks to that? Like if we're creating sort of pretty complicated protocols where they're managing liquidity across different blockchains with different consensus requirements, mechanisms, and everything, like maybe initially it might be safe, but if that gets really big, could it get kind of risky?
Yeah, I think for sure, anytime you get into things that are lending market and cross-chain, there's a lot of risk involved, right? Like those are the two things that have historically seen the most amounts of hacks, I would say. Um, the trader in me is definitely a lot more risk off. So I don't know if I'll be using these things like initially from the get-go, but I do think that over time, as the infrastructure and the smart contracts do become more and more robust, it is definitely worth that risk. Like the amount of unlocks that can happen just from the perspective of capital efficiency, I think is quite huge, especially if there's more and more chains launching every single year, and a lot of them are getting quite big, like Hyper EVM. There's a bunch of L2s. Obviously, you have Ethereum mainnet. I do think that this type of solution is definitely necessary.
Yeah, that's a good point. It's one of the things that I'm kind of curious about is given this surge in just it's a real world assets, specifically U.S. Treasury debt and private credit. Like, who are the people who are utilizing these? I believe it's the total market cap already, as I said before, is like 28 billion. So the primary use cases and borrower types driving demand for DeFi money markets. Like, what are these people doing?
Yeah, it's a good question because I mean that's a huge number, like almost 30 billion. But if you like ask around, your friends or people like within your circles, you probably won't know that many people that are actually utilizing these things. I mean, that's one of the things that we're trying to change at Theo. Like, we want to make it so that these assets are really easy to use across a multitude of different protocols, including ones like Felix. Like, we have an integration with Felix, and you can borrow against TH-Bill there. So I still think that's a work in progress, to be honest. Charlie, I'm not sure if you had any other takes on that.
Yeah, I think it's been good to see some of these use cases sort of evolve a bit. I think overall, I think I'd bucket it in a couple things. Like the first is users who are still just using crypto. It's a few different trades, but on Hyperliquid, it's mainly, hey, I want to borrow to trade more on other chains. Maybe I want to borrow to Loop specifically right now. That's been a big trade. We talked about the PTs piece earlier, but that's become, a massive part of DeFi TVL in total. I mean, if you just look at, PT looping on Aave, Morpho, any sort of top money market protocol, it's a massive percentage. But then I think the other piece here on the non just kind of crypto native asset side or more RWA assets is just the real power of offering composability for these assets or use cases or real kind of usability. I think a lot of these assets that people might hold in a traditional brokerage or something like this, it's very difficult to actually put these assets to work. And so in DeFi directly through money markets, that can be achieved. And I think we're sort of just seeing the first glimpses of that now. Obviously with TH-Bill and other assets that, the guys at Theo are working on, it's pretty cool to see. So yeah, I said we're something we're pretty excited about too.
So I'm actually kind of curious about this, given we're seeing a merge, like TradFi and DeFi kind of merging now, especially with tokenized stocks. I think the Nasdaq even announced that they're going to allow for trading of tokenized equities 24/5 via their platforms. Like, does this mean that people are going to move away from on-chain and like self-custody? Does it change how people even view custodying assets on exchanges? They offer more like robust product types. Kind of curious how that like end state for this consumer-esque DeFi looks in your guys' end.
I'd say potentially so, but I think almost it's a demonstration that they understand that the value of trading these assets on chain is becoming more and more clear, and that they can no longer, kind of sit in this bubble. I think it's interesting to think like, why now do we see them trying to make this shift when we're seeing, multiple new real world asset deployers, multiple assets coming on chain that were not on chain before, types of assets. You're seeing like it's small, but sort of a slow acceleration of tokenized equities. Hopefully, eventually, we see perps on equities or different kind of different things you can do with these assets, particularly on chain. And so I think it's in part I think it's less around this is a drawback to the old system and more of this is a sign of, oh, the new system is bringing something pretty promising.
Yeah,
Sorry,
I
yeah.
would definitely. Yeah, I would definitely agree with that. I think like, if anything, it's more of a sign that these more TradFi institutions are kind of seeing the explosion in on-chain growth, and they want to be somewhat, a part of that. I mean, if you look at just the rate at which Hyperliquid has grown, for example, like it's almost unheard of for a business in like TradFi or Web2 to grow this quickly to this size. And so I would say like, DeFi and just like decentralized systems in general has definitely caught everyone's attention.
Oh yeah, I mean it's insane what's going on via the USDH ticker proposals. That Hyperliquid Discord must be really popping right now. I should probably join to check it out myself. But I guess it's kind of interesting seeing that like institutional capital like is clearly willing to dabble on chain. I mean, Paxos, I guess, put forth an even juicier proposal than they previously did, and folks clearly have a vested interest in not just buying a ticker, the actual support of these ecosystems. Like, how are institutional players influencing the growth of tokenized real world assets? Like, and more so bringing these incumbents like on chain from your guys' perspective and all these assets, really.
Yeah, I think institutional players really view, or at least they're starting to view, these decentralized rails as another method of distribution and one that scales very, very quickly. And so naturally, like if you're an asset manager or somebody who can issue things, putting it on chain makes a lot of sense because you just get so much access to capital and an already big user base that's very financially savvy. So I think that this is a trend that will continue. Like we've already seen huge players like BlackRock come on chain. I think, it's a matter of time before pretty much every single major asset manager does the same thing. And I think it probably won't stop there. Like the banks are also very clearly interested as well. I speak to, I'm based in New York City. I have a lot of friends who are like bankers. Like they're very much aware of what's going on in the on-chain and like the DeFi landscape. And I think it's only a matter of time before everyone kind of wants a piece of that pie.
Are we going to end up in a state where we have like a permissioned sort of crypto ecosystem and a permissionless ecosystem? Like I'm not maybe super familiar with BID or sort of the other ones that already exist, but I'm assuming they're largely permissioned for now at least, right?
Yeah, there's especially if you want to access the US markets or market towards US citizens, there's definitely a layer of permissions that you have to add to it. I think that is something that can coexist with like the more permissionless side of things. So in my opinion, like you're kind of spot on. I do think that there will kind of be two layers to it. A side that is more permissioned. There's more, KYC or KYB requirements in order to participate, and a side that is more sort of really DeFi native, if that makes sense.
Understood. I mean, it was interesting. I spoke with, I met Surya Nazarov. He did something with like the block research, like a quick talk a few months ago. And he spoke about like the illegitimate and like legitimate sides of crypto. So on one side, you had like tokenized assets, like really RWAs, stable coins, and think more so like traditional infrastructure. On the other side, you had things like NFTs, meme coins, and he gave like one other example. It's a good three analogy, but it feels kind of weird now. I don't see it being as clear what that line in the sand is. I mean, there's protocols now you can take out loans against meme coins. There's NFT lending. It's occurring buy now, pay later type of activities. It's really robust. So I used to think initially that it would be almost like this bifurcated type of these two systems operating in parallel, but now it just seems like there's going to be a ton of gray area, especially now, even with the onshoring, it seems like, or allowing US users to trade via these offshore trading venues. So, I mean, who knows what the future looks like.
Yeah, I think the piece I'd push back on slightly that there'll be two distinct venues, over time, and it ends up in that matter is that um, I think a lot of this stuff things concentrate around where the liquidity is, and so wherever that liquidity scale tips, that's probably where eventually the seesaw just slowly falls all the way that way. I think you could say, if you step back on a higher level, hey, DeFi will only exist and TradFi will exist parallel. But I think what we're slowly seeing, what we're mainly trying to get at here is like, no, a lot of that TradFi liquidity is slowly flowing over because they're seeing the benefits of it. And it's not just like, no, you only trade Bitcoin and Ethereum on blockchain rails and you'll trade all these other assets, any other real WA, just via your brokerage. I think we're seeing that's not really the case. And I think, it's probably more likely that we try to see a lot of these brokerages keep trying to offer crypto assets, but they're not going to do it as well as they can be done on chain. And obviously that's the bet that, I think the four of us are probably taking overall. But yeah, I think that's kind of where I see it tipping more and more. It's just a slowness. Like, I mean, as an example, like you see someone like an IMC right now, who's like a hyperliquid validator. Like, I don't think 5 years ago anyone would have thought like IMC, one of the largest, trading shops in the world, is something like a on-chain validator, putting in like governance proposals and holding large stacks of this, like, this asset that was just launched, less than a year ago. So I think it's kind of interesting to see that keep shifting, and hopefully we keep seeing like one system that wins out, and that's the permissionless system.
Interesting. I guess one thing I'm kind of curious about is what the onboarding challenges are that may limit the growth of RWAs on chain via this permissionless future that you guys are discussing.
Yeah, I think that the main kind of friction point that exists right there right now is for most of these RWAs, at least, if you want to be a minter or a redeemer, you do still have to KYC or KYB. And so there are pretty strict requirements around that. And, of course, you have to operate in the most compliant way possible. So there's really no way around that, in my opinion. What that means is that, like, if you're just a regular trader or a regular user, you'll never have the capability to like mint or redeem something. Rather, you have to rely on sort of like an external market maker, somebody that's like willing to kind of take on that role to do that stuff for you. So I think that's one of the onboarding challenges that exists right now. It's not super, like, even if the asset itself is permissionless to trade, there are still sort of some blockers, if that makes sense. And yeah, I think that's probably the biggest one that I see right now.
Understood. And one of the things I'm kind of curious as a follow-up then what would be the biggest value unlock that would foster this RWA demand outside of this mint and redeem compliance piece that you mentioned?
I think it's liquidity and making it easier for these things to be able to be market made on chain. Like, if you think about an RWA, it trades primarily in TradFi venues, right? Like TradFi exchanges and TradFi brokerages. And a lot of the existing players right now, like existing crypto market makers, don't have the infrastructure or even like the capabilities to plug directly into those venues. And so I think it's something that will take a little bit of time. But once there are more players who can actually, hedge on TradFi venues and provide liquidity on chain efficiently, that's when the big unlock will happen. We're seeing that beginning to occur right now. Like, I speak to a lot of market makers, and a lot of them actually are beginning to start hire for like the more TradFi side of their business, which is interesting because normally it's the other way around. It's like the TradFi market maker coming to crypto, but now you kind of have the other movement too because of RWAs. And I think that once that really kind of comes to fruition, like we'll definitely see a lot more volume, a lot more depth of liquidity, and just a lot more usage in general.
Yeah, I guess the only piece that I'd add on there is just I think the value unlock of use cases and more use cases for these assets, more than just buy and hold on chain. I think a lot of users that I've spoken with, it's, buying and holding on chain is great if you're just trying to keep assets on chain and you don't want to be, having assets in these two separate venues. But I say a larger user base is more interested in RWAs on chain because of what they can do with the assets. And so as these kind of assets become more and more integrated throughout DeFi platforms across chains, I think that things get a lot more interesting then.
Understood. And are there any like interesting retail preferences that you guys observed in your conversations working with builders and users of your protocols?
Retail preferences in like what sense?
Like we'll say fixed versus variable yield strategies. Are people
Uh,
looping a lot consistently? You're noticing
Yeah,
things like that.
definitely. There's a lot of demand for looping. Like that's definitely one of the major metas right now. So, and this is across like pretty much every lending market, whether it's Aave, Morpho, Euler. I think there's a huge preference for people to loop points because as long as they can keep those like borrow rates down, they can basically leverage the incentives and the yield that exists and earn a lot more. So something that might, like if you just held it in your wallet normally would yield like 7 or 8%. If you loop it a few times, can easily yield like 15 or 20%. So I think that's a huge, definitely a huge preference for the users right now.
Understood. Charlie, anything on your end?
Yeah, I would second that. I think we've seen a lot of demand for fixed rate. So that's kind of a piece that we're looking at pretty heavily. Sort of to TK's point there, but on the looping side, if you can loop at a fixed rate and you know that that rate is pretty high and you can lock in that rate, if you can also lock in a fixed rate on the borrow side and you can really just guarantee a yield there, I think that's very interesting for a lot of people, especially if you can do that at scale. And that's the main question is like, can you do this with 500K, 500 million, or 50 billion? If it's the latter, yeah, it gets very, very interesting. So we're trying to figure out ways to get to that.
Understood. And I guess what are your forecasts for institutional capital growth in DeFi over the next 3 to 5 years?
Hard to put a exact number to it, but I think it's going to be quite a lot. Definitely in the tens of billions, if not the hundreds. That's all I would say.
Yeah, my forecast sits at $13.5 billion. No, just kidding. I don't have an exact number either. But yeah, I'd second TK's. I mean, I think like we're just seeing more and more firms that, um, I would not have expected to be doing anything on chain at the scale that they're doing. So, call it 3 years ago, especially, 2.5, 2 years ago, post FTX. But a lot of firms are kind of warming up in kind of getting over that scare now, and I think it's very helpful to see.
Nice. Yeah, it's understood. Predictions of the future are oftentimes wrong. Predictions of technology are probably even further off. So, no worries. We're not going to hold you to that. One of the things I was curious about was what market catalysts might accelerate this institutional and retail participation in on-chain finance.
Definitely the biggest one was like regulatory related. So as regulations become more and more clear, like we just had the Genius bill pass, but I think there's a couple more on the horizon. These institutions will feel more comfortable into allocating on chain, in my opinion. And so I think that's by far the biggest one. The other one is, I think, I don't know if you guys would consider things like Stripe an institution, but I almost view it as not really an institution, rather like fintech. As more of these like fintech players come on chain or start building in like the crypto ecosystems, I think that will actually lead to like institutions feeling more like comfortable coming on chain as well, like almost sort of like a gateway for these institutions to come on board really, really seamlessly. And so I think that is another major driver. I mean, obviously, we all saw like the whole announcement with Tempo and things like that. So I tend to believe that these things will definitely be a much more viable place for a lot of these more conservative institutions to like kind of get into the whole blockchain ecosystem.
Yeah, and in terms of regulations, did you think the poly market CFTC announcements were quite meaningful?
I actually haven't looked too deeply into that, but I'll have to check it out for sure.
Yeah, I guess I'm on that side. Yeah, and I do think that that makes quite a difference on it, Tim. I guess I would second TK's point too on like it's no coincidence that you see Genius go through and then you see Tempo and you see all these stablecoin chains, the Plasmas and the Stables of the world, and then you also see the DAT meta, picking up and taking off further. Like these are just more and more venues for onboarding capital on chain in a way that now feels compliant. Whether there's that actually big of a shift in what's actually happening with this regulation is, I guess, TBD. But just the fact that it's out there, I think, brings a lot of security and also a feeling of security to a lot of these firms that want this, and their LPs want this, and so that was a pretty big opener.
Understood. So one of the things I'm kind of curious about, Charlie, then from your perspective is, given there's a lot of optimism generally from traditional finance players, is it the people who are waiting for regulation were kind of already going to jump in, or maybe people are a little crypto curious, say, okay, this is an inflection point, it's now worth paying attention to?
It's a good question. I would say I'd say it's probably a fair split. I don't know exactly. I don't have any data to prove on that side. Just only passing conversation, but yeah, I think there were a fair amount of people who were sidelined and then feel that this is a moment, not only regulatory, but also new administration and more crypto favorable administration. That this is a moment to dive in. But then I think also, yeah, I think it's a place of your crypto curious people who maybe they weren't planning to dive in fully, call it 3 years ago, but now makes more sense for them. I don't think that's off the table either. So probably a split.
Understood. And I guess, are there any, going back to the retail side, are there any like retail-friendly ecosystems that you guys are specifically interested in or working with that you think will help onboard this next influx of users into on-chain DeFi?
I mean, obviously, I would say I'm pretty biased on the Hyperliquid side. I think there's a lot of interesting things to see there and builder codes, HIP-3, new modes of distribution, all of this. But stepping away from that, I would say Base is an ecosystem that I'm pretty interested in. I think a lot of this, in my mind, comes down to distribution. I think Base through Coinbase has some of the best distribution. I think Coinbase will really get even more distribution for Base. So that's certainly a chain that I have an eye on. I know Arbitrum is doing some interesting things there to try to build a position on that side as well, along with other L2s. So, but yeah, that's why I'm watching a lot right now.
Yeah, I would say I'm also very excited about Hyperliquid for this as well because it's almost one of those products that you use and you don't really feel like you're using something that's decentralized, which I think is huge for onboarding users who are maybe not so crypto savvy. The other one that I would say are like these stablecoin chains are really interesting to me because they're targeting a lot of like businesses and a lot of use cases that require like payments or like remittance sort of systems. And so by doing that, if you like onboard these businesses, like they will naturally onboard more users themselves. And so I think that is another sort of big potential area where we'll be able to get more users who aren't in crypto to start using crypto rails.
Well said. And so it seems like TKU generally just bullish these stable chains. I guess, why are these not just another L1 from your perspective?
That's a good question. I'm still like a little bit split on exactly where I stand with them, but I think I'm generally bullish. And I mean, if you have like the founder of Stripe and also the founder of Paradigm who are this deeply invested into something, there's definitely something there is what I would say. And so I think there's a good point, like it's very obvious that something like Ethereum is not a great chain for payments because it's pretty expensive to use. It's not super fast. The TPS isn't so high. And so I think there's a very easy argument to be made on that side of things. I think the L2s are a little bit better, but it seems like these chains are all trying to make some custom features into them. Like for example, I was reading a blog from the stable team, and they are basically creating sort of like dedicated lanes for large like payment users, and I think stuff like that can be really cool. We'll see if it sticks or if it takes off, but I do think that there's a lot of potential there.
Understood. I guess Charlie, any comments for you regarding stable chains?
Yeah, I'd say I'm interested in them as well. Cautiously optimistic on the value prop. I do think a lot of it in a similar mode as why I'd be bullish on the Hyperliquid comes down to distribution. I think the Stripe distribution is auto value add if that actually plays out, along with seeing that stable has some pretty good rails there as well, and potentially Plasma with this Binance integration, what they can do, try to push flows away from Tron. But yeah, I think it's TBD exactly on the net new unlocks of the chain itself, and more I think it's an interesting BD game if nothing else. So we'll see.
Understood. Well, that's all the time we have for today, guys. But I did want to thank you both, TK and Charlie, for joining the episode. And as a reminder, our newsroom works tirelessly to get you accurate, informed crypto news. If you want to stay ahead, read the block. Thank you, and I'll see you next time.